Welcome back to Metal Market News. I'm Professor Harry, and as always, I'm here to break things down from an independent analyst's perspective, cutting through noise and focusing on what actually matters in the metals and macro space. And what we're looking at right now is not just another short-term fluctuation in gold and silver, it's a layered situation where technical pressure, speculative positioning, monetary dynamics, and geopolitical forces are all interacting at the same time. And that's exactly why many investors are misreading what's actually happening beneath the surface. Because if you only focus on price action, you completely miss the structural story that analysts like Alastair McLeod are trying to highlight. Which is that the real issue is not whether gold or silver are too high or too volatile, but whether the underlying credit system itself is steadily losing value. And that distinction changes everything when you start thinking in long-term terms rather than reacting to short-term noise. Cicero Jerome. Because once you shift your perspective from nominal prices to purchasing power, the entire narrative flips, and suddenly what looks like a volatile or even weak market becomes a setup for a much larger repricing event. And that's where McLeod introduces the idea that commodities priced in gold are still historically cheap, which implies that the move we've seen so far might not even be the main event, but rather the early stages of a much bigger adjustment. Potentially on the scale of 300 to 500% across the commodity complex when measured in weakening fiat currencies. And while that sounds extreme at first glance, from an analytical standpoint it's not entirely unreasonable if you accept the premise that currency debasement is accelerating. Although from my own perspective as an independent analyst, I would caution that this kind of outcome is not guaranteed or linear, because commodity cycles are influenced not only by monetary factors but also by global demand, industrial activity, and supply constraints. So while I agree with the direction of the argument, I would frame it as a high probability long-term trend rather than an immediate or inevitable explosion, especially given the current global economic uncertainties that could delay or distort that move in the short to medium term. Now, when we move deeper into the mechanics of what's been happening recently, one of the most important points that gets overlooked is the role of regional speculation. Because according to McLeod, the recent buildup in speculative pressure didn't actually originate in Western markets like COMEX or London, but rather in Asia, particularly in China. And this is critical because it challenges the mainstream narrative that the recent pullback is some kind of broad speculative unwind across all markets, when in reality, the data suggests that Western positioning has been relatively light, especially in silver where open interest is sitting near multi-decade lows, which is not what you would expect in an overheated or crowded market. And from my perspective, this is a strong point in favor of the bullish case, because historically, major tops tend to occur when participation is extremely high and positioning is crowded, not when interest is relatively muted. However, I would also add that low participation can sometimes reflect a lack of conviction rather than a hidden buildup. So while it reduces the risk of a major liquidation event, it doesn't automatically guarantee upward momentum either. And this is where nuance becomes important, because markets don't move based on a single variable. They move based on the interaction of multiple forces. And in this case, what we're seeing is a divergence between perception and reality, where many investors assume the market is overextended, while the actual positioning data suggests the opposite, which creates the kind of environment where sharp moves can occur unexpectedly. Unexpectedly. Especially if sentiment shifts quickly at the same time. We also have to account for the technical pressures that are currently influencing price action, particularly in the short term. And this is where options expiry and futures contracts come into play. Because when silver was rallying aggressively, a significant number of call options were placed at higher price levels, and the entities that sold those options have a clear incentive to push prices lower so that those contracts expire worthless. Which is a completely normal part of how derivatives markets function, but it can create misleading signals for anyone who isn't aware of these dynamics. And when you combine that with futures expiry, where traders often close or roll over positions to avoid taking physical delivery, You get an additional layer of selling pressure that has nothing to do with fundamentals. And from an analytical standpoint, this is one of the most important distinctions to make. Because technical declines driven by contract mechanics are fundamentally different from declines driven by changes in underlying economic conditions. And in this case, the argument being made is that nothing has actually changed on the fundamental side, which I largely agree with. But I would also emphasize that timing remains a critical factor, because even if your long-term thesis is correct, short-term volatility can still shake out positions and create significant drawdowns, which is why understanding these technical cycles is essential for risk management. Not just for analysis. When we expand the lens further to include geopolitics and energy markets, the picture becomes even more interconnected. Because tensions involving Iran are not just headline risks, they have direct implications for oil prices. And oil, in turn, acts as a transmission mechanism across the entire commodity complex, affecting production costs, transportation, and ultimately pricing across multiple sectors. And this is where McLeod's argument about commodities being cheap in gold terms becomes particularly interesting. Because it suggests that what we're seeing is not an overvaluation of gold, but rather an undervaluation of commodities relative to a stable monetary benchmark. Although, from my perspective, I would approach this conclusion with some caution. Because gold itself is influenced by a range of factors including real interest rates, central bank activity, and investor sentiment. So while the relative valuation argument is compelling, it shouldn't be viewed in isolation. And instead, it should be integrated into a broader analytical framework that considers both monetary and real economy variables. And when you do that, what emerges is a scenario where commodities have significant upside potential, but that upside is likely to be uneven and influenced by external shocks. Particularly in the energy sector, which tends to act as both a catalyst and a constraint depending on how prices evolve over time. Finally, when we get into the discussion around inflation, bond yields, and the future of fiat currencies. This is where the analysis becomes more structural and long-term, because McLeod challenges the conventional view that rising bond yields are negative for gold, instead arguing that both are responses to the same underlying issue, which is the erosion of purchasing power, and therefore can rise together rather than move in opposite directions. And while this perspective is theoretically sound and supported by certain historical periods, I would argue that in practice, the relationship between yields and gold is more complex and often depends on broader market conditions, including central bank policy and growth expectations, because yields are not purely market-driven in today's environment. They are heavily influenced by policy decisions, which can distort traditional correlations. And this brings us to the larger question of fiat currency stability, where McLeod takes a very strong stance that all fiat currencies eventually decline towards zero, unless anchored by something like a gold standard. A view that aligns with classical monetary theory but may not fully account for the adaptive nature of modern financial systems, although the underlying concern about long-term currency debasement is certainly valid, especially in a world characterized by high debt levels and persistent deficits. And when you combine that with historical examples like the Weimar Republic hyperinflation, it becomes clear that while the exact path may differ, the risk of significant monetary disruption cannot be ignored. And from my independent analysis, the most realistic outcome is not an immediate collapse, but a prolonged period of gradual debasement, punctuated by occasional shocks that force repricing across multiple asset classes. Which means that while the long-term case for gold, silver, and commodities remains strong, the journey is likely to be volatile, non-linear, and heavily influenced by both technical and macroeconomic factors, making it essential for investors to stay grounded in data rather than reacting to short-term price movements that may not reflect the bigger picture at all.